And the bull market can't be over because it hasn't started yet. If everyone thinks there's a 4-year cycle, to some degree that becomes a self-fulfilling prophecy. But it's breaking down. We're in a real, deflationary spiral with BTC, and that's accelerating as you get more whales who just hold, more hodlers, if you will, more losses, and fewer mine. And plus bigger actors buying. And my God, that's the textbook definition of a supply shortage, which always leads inevitably to higher prices. But the biggest catalyst by far is...
Book reminder, nothing said on Supply Shock is a recommendation to buy or sell any investment or product. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions of companies, funds, or projects discussed. Pete Rizzo, the Bitcoin historian on X, here with another great episode of Supply Shock. Today, we're going to be diving deep into the market mayhem that's taken place over the last week with one of the true veterans of the trade. I'm talking about Tim Enneking of Stallion, an institutional level investment product manager. But really someone who has been looking at the Bitcoin and crypto markets since their earliest formation. That's right. You can go all the way back to 2013-14 to the archives of CoinDesk. You'll see Tim opining about the Bitcoin price action at the time. So, Tim, welcome to the program. And $87,000 at present. It's crashing. It's over, right?
It's funny. I'm not sure that it's even crashing. One of the, or has crashed. One of the fascinating things about Bitcoin is watching the market itself evolve. And there's a principle, I will call it now, that I very jokingly call Enneking's law, which, like Moore's law, is that the profile of the average Bitcoin investor changes every 18 months. And, at the beginning, it was the libertarians and bleeding edge tech guys, and then slowly evolved into some, almost like a get rich quick meme sort of thing. What meme coins and meme stocks hadn't been invented then, but evolved to that. Then it got a little bit more serious and a little bit more mainstream and, high net worths and small institutions or whatever. Then it got into big institutions, and now it's evolving to... haven't quite hit countries mainstream yet. I think that'll be the next iteration of Enneking's law. And now we have treasury Bitcoin treasury companies, and a lot of this we could generalize to crypto as well. But if you go back to 2013, it was just Bitcoin. And I distinctly remember, Pete, days when you would have a 40% drop in the price of Bitcoin, followed by a 50% increase. It's really funny as I listen now when there's a 3 or 4% movement. Oh my God, the sky's falling, and I just laugh and laugh. You guys have no idea.
This wasn't supposed to happen, right? We got a bunch of new investors coming in, and they were here for, there's the 4-year cycle. This was the 4th year, the 2013, 17, 2021. Right. They should be up, right? They should be cashing out right
Absolutely.
now. What do you make of this market cyclicality is broken?
It's breaking, and it very clearly is, and for a very, very logical reason. If you go back to, let's take your first year, right, 2009 rather, it doesn't really fit this cycle. There wasn't enough interest in the whole concept.
It wasn't even a price for most of it.
Exactly. So let's take 2013. And you had the halving. Now, at that point in time, actually, it's an interesting question. I haven't looked at how many have been mined there, but it was probably 10 to 20%, right? So very, very small portion.
50, it was actually close to 50% because the way the halving works is that the halving reward corresponds to the percentage of inflation. So the first halving went from 50 Bitcoin to 25.
No. I'm not talking about the halving is the halving, right? It's 50% each time. What I mean is what percentage of Bitcoin had been mined at that point in time. It
Oh,
wasn't
right.
50%. It was much less than that. I suspect it was in the 10 to 20% range, 25 max. But anyway, if you look at that, then the vast majority of Bitcoin remained, and a large percentage was controlled by miners. So when the miners lost half of their rewards, that was a big deal. I mean, that had a massive impact on the market. Same thing in 17. 17 were probably around 50% mined. Same thing in 21. We're probably about 75, 80% mined. But as of right now, 25, right? And it's the end, so you have to take a percentage, a point or two off. 93% of all Bitcoin have already been mined. And at that point in time, if you look at it now, who are the biggest Bitcoin holders? It's got nothing to do with miners, right? Miners are non-trivial holders. Don't get me wrong. But when, Saylor's strategy has almost 600,000, when the United States government, which is really frightening, has 250,000, which they didn't buy. They just confiscated from various people, and Trump ordered them all to, pilot all together. And oh my gosh, it's actually, 10% of, not 10%, 0.2% about 200,000, so 0.1% of outstanding supply, but it's still non-trivial. And then you figure at this point in time, nobody really knows, but between 10 and 20% of Bitcoin are probably lost. We have a famous guy in his landfill outside London and all this other stuff. And the influence of the miners as a result, with only 7% left to be mined, with the miners themselves holding only a small portion of the Bitcoin that are outstanding, the 4-year cycle shouldn't have that much of an impact anymore. People like it because it's super convenient, right? Hey, buy here, sell there. Just let me follow the cycles. Do we have the peak 6 months after, or does the next bull market start 6 months after the halving? Does it start 3 months? Does it start immediately? And that, all of those things, the predictability of the cycle are very, very nice. So what happened this year is, for the first time, mainstream media and other, and just people in general know much more, follow Bitcoin much more closely. And when that halving happened, there's so many people that didn't have any history going, oh my God, the halving, it's going to go up. Plus, right around the same time, we had the spot BTC ETFs being approved, right? March 11th of last year. And that was the same month as the halving. So you get this very early spike, and you never had that before. So that already distorted the bull market. If nothing else, spread it out. And so then you went down, you had the doldrums all last summer. It went up a little bit at the end of the year. Then at the beginning, that continued. Then you had more doldrums. And then, boom, we hit the 126 and change 7 weeks ago. And, boom, we give away a good third, 35% already of the price over those 6 weeks. But if you look at the historical cycle, there's some similarities, right? But we never had a peak. The peak was like 78, 79 in the spring of the year before. Because remember, 2024, 2020, 2016, those are bad years. They're not horrible years. It's the year after, right? So that you listed 13, 17, 20, 21, 25. It's 14, 18, 22, 26 that absolutely stink. They're horrible years. And now, and if you looked at the normal cycle 2 years ago, I said, okay, September, October is going to be the peak. And it wasn't me being prescient or anything. It was past cycles. Well, we've had a peak in October, but I don't think it's the peak, because we had one peak too early. Now we have this one too late. And I don't think the bull market is over. I was reading some article, I think in your old publication, and a gentleman said, we can't, the bull market can't be over because it hasn't started yet. And I found that logic to be as compelling as anybody's. But now when you have so much Bitcoin, such a high percentage outstanding, and in the hands of large institutions where making making money on BTC or losing money on BTC is, basically rounding error, if that. They're not, they have diamond hands. They're not worried about looking at this over time. Saylor, on the other hand, has a huge amount of skin in the game. And the moment Saylor starts to sell, Bitcoin loses, 10% of its price. But he's also holding on when he's completely convinced that the future lies in BTC. And his company has so much, it's almost counterproductive, because it certainly brings back centralization reminiscent of central banks or something. But overall, this is a healthy retracement. I don't think it's the end of the bull market, because if you look at the percentage increase from peak to peak, it's barely noticeable. So it may be that there's a secular trend here that everything is going to get damped down in BTC. And certainly there's a lot less volatility. Certainly there's a lot less, there's much more correlation to risk on assets in the fiat space, the TradFi space. So this is a very, very different Bitcoin from 4 years ago for all sorts of different reasons. Overall, it's healthy, but it's also much less predictable.
So before we move on, it sounds like you're saying the 4-year cycles, this is broken. You're not looking at this going forward as an indicator for how to trade the markets.
Interesting way of summarizing it. I would say is breaking. It's not broken, but it is breaking. I clearly look at it, but I look at it more. There's this strange phrase that I think I actually coined: historical financial inertia. Because Bitcoin hasn't been around very long and there are always these 4-year cycles, it's really in the mindset, it's in the psyche of a crypto investor. So if everyone thinks there's a 4-year cycle, to some degree that becomes a self-fulfilling prophecy. But it's breaking down because, again, the Enneking's law, the profile of the average investor. The average investor is changing. The average investor holds far more Bitcoin, even though it costs a lot more money. It's more institutional, and newer. And those folks are going to look at Bitcoin, look at the 4-year cycle, and go, yeah, okay, used to be there, clearly isn't anymore. If everyone thinks it's going to be, I got to bear that in mind. But let me trade what the market gives me. Let me not trade what I think the market should do based on these 4-year cycles.
Well, I got to ask then, the big question is, if we've got these new institutional diamond hands, we've got these financial professionals who are convinced, who's selling in your view in the market right now?
It's interesting. There are people who obviously don't have diamond hands. There are people who are concerned about the dropping price. And I love the concept of capitulation. In one of my trading funds, the one trading fund I have now, when FTX announced its bankruptcy in November 15th of 2022, we took all of our assets and moved it into Bitcoin and Ethereum. We made no trades in 2023. And that fund class actually was nominated at the Crypto Hedge Fund Award, Hedge Week in London, as one of the top performing funds in crypto. In 2021, it had been the top performing fund in the world, but in 2023, it was nominated for this. It didn't win. We were in the top 3 or 4. I don't remember which, but we did zero trading because all we did was move in at the capitulation. And at the time, I called it the artificial FTX capitulation. And that psychological effect applies at least as much to TradFi as it does to crypto or to Bitcoin. But when everybody is screaming, run for the exits, that's the time to find the nearest entrance. And so we went in and did very, very well on that. What we're seeing today is also indicative of that. You saw last week and this may be over, it may be the famous dead cat bounce or whatever. I have a feeling it's probably enough. But everyone was just screaming, "Oh my God, it's going to fall! It's going to fall! It's going all over!" And you didn't have quite total and complete capitulation, which muddies the waters a little bit. But you had people being really, really discouraged, calling for 60K Bitcoin, six handle, as they say, so in the 60s or whatever. I think it went lower than most people expected. It went lower than I expected. My crystal ball was wrong. But when everyone is saying it's time to get out, that's the time to get out.
Well, of course, obviously, people wondering and worrying about the systemic health of the Bitcoin and crypto networks, right? Traditionally, when we've seen the end of these cycles, we do see the breakdowns, right? You see your Mt. Goxes, your FTXs. And so there's a lot of people online sort of, looking around, right? I think Tom Lee on CNBC, suggesting that, someone, would be discovered, that there'd be some sort of failure in the markets. Do we see a sort of failure of the infrastructure in the market, or do you think that is driving what's happening right now? Or is it just, as you say, sentiments are low and expectations were maybe too high?
That's really interesting theory. I haven't thought about structural failure driving the bottom or indicating the bottom. It was certainly an FTX, right? So obviously it was there. I think there's a confusion of cause and effect. The market is going down, therefore you have failures. That would be indicative of capitulation in the bottom, and then it goes up. I wouldn't say that it's a failure in normal cases. FTX, I think, is an exception because the market was already going way down. And part of the reason FTX failed was because the market was going down, right? Had the market continued to go up. So I think there's a confusion of cause and effect there. If you're looking for something similar, okay, prices are going down. Where is the systemic failure? Tom Lee, as a matter of fact, is the guy that came up with the idea is, hey, I think when there was that 20 billion wipeout in one day in October, I think that really cleaned out the balance sheets of market makers. Therefore, you have much less market making going on. And market making is the grease that makes the gears of markets turn. Because you don't have so much grease, it's not turning as much, and the market is going down. I don't know whether that's true. I don't spend any time analyzing balance sheets of market makers to the extent that's even publicly available information. It's an interesting theory, but I would not say, hey, it's the collapses that show the bottom. I would say it's the bottom that causes the collapses. It's another indication of capitulation, certainly. And a lot of companies in 2018, they went under because prices had just gone down too much from the peak of what was about 20,000, right? And so I think the cause and effect, to the extent it's there, and I suspect it is, but it's the other way. And it might be kind of coterminous, right? Prices go down about the time it causes institutions to fail. There'll be some more mucking around on the bottom, but then we'll get a recovery.
I'm curious for your perspective on this. There are some folks who sort of see this as a sign that Wall Street is kind of coming into the industry and they're counter trading our expectations, right? There had never been an all-time high before the halving. All of a sudden, there's an ETF. There's an all-time high before the halving. We're supposed to have this big Q4 blowout. There's always a 4-year cycle. Now we're sort of getting the opposite. So is there a sense, or do you get a sense that there are sort of bigger players in the market, maybe newer entrants that are just sophisticated, and this is the evidence of their sophistication, is that they're breaking these trends that has historically been there?
Absolutely. That's what I said earlier. There are a lot of new entrants, and they're looking at what the market tells them, what the market says, versus what the historical trend, if the cycle works, where it should drive it. And absolutely, if they think everyone's going one way, they're going to be prepared to take advantage of that. Because look, traders make their money. They are successful by trading what the market gives them. They aren't successful by saying, okay, I'm predicting the market's going here. I'm going to put all my money in that and let's go. They'll certainly be right sometimes, but you only need to be wrong with that sort of approach once and you're completely wiped out. So the earlier thing you said about the high with the halving and the ETF, that was purely news driven, very, very much retail driven. Everybody, let's go, let's buy. Anybody paying attention to the 4-year cycles was completely caught out by that. it made no sense. And then what happened? It fell right back, and we had 6 months of some of the flattest ever movement of BTC. And with the institutions, I mean, look, you can buy Bitcoin now on PayPal. You can buy it on Stripe. You can, it's everywhere. The fact of the matter is that there's not any, like insiders, the guys that know how the plumbing works. They're not the only ones that can buy and sell Bitcoin anymore. They have a lot of Bitcoin, but the 4-year rule is breaking for the reason I mentioned. It really was a function of supplier supply. So it really was how many Bitcoin the miners had. And if you look, it wasn't the day of the halving you felt the effect. It was 3 to 7 months later. And that just meant that there was enough on the miners' balance sheet that they could absorb or push out the impact of the halving. But at some point in time, they had to start selling on the one hand, but they also were selling less because they were earning less, and that caused a scarcity value and BTC would go up. Now, Wall Street says, to your point, hey, this is another risk on asset. And so you have this bizarre correlation, which actually it's unfortunate that it happened in a bear market, but the correlation started breaking down about 6 weeks ago. But until then, you have this bizarre correlation. And since China's kind of out of the business, at least on the surface, between US equities markets and BTC. But the problem with that, and I published an article on this, I don't know, about 6 years ago, is that if you look at the percentage of time that fiat markets are open, fiat equity markets, the one that's open the longest, strangely enough, is the LSE, the London Stock Exchange. And then look at how 24/7 markets, right, 169 hours. Fiat markets are open just over 20% of the time that you can buy and sell Bitcoin. So saying they're correlated is really moronic from one perspective, because 80% of the time there cannot be a correlation, because you cannot correlate a market that's open with a market that's closed. So I've read some interesting statistics. If you, for instance, last year were to buy Bitcoin when fiat equity markets in the U.S. open, sell it when it closed, you would have lost 20%, something like that. If, on the other hand, you bought Bitcoin when markets closed and sold it when they opened, you would have doubled, almost tripled your money. And I haven't verified these statistics, but I'm sure as a general rule, that's absolutely right, because BTC generally does much better when there isn't downward pressure from fiat markets. In the last 6 weeks, you've seen that correlation go down for whatever reason, right? It's really not clear to me who is selling, but I don't think there's a lot of selling pressure. There's just not a lot of buy side support. And that's why the idea, the theory that maybe market makers aren't stepping in, to me, probably has some credence.
Well, I want to talk about catalysts. A lot of people looking for Q1, Q2, and really just, this year we saw an explosion of, just really turbocharged headline narratives, right? The strategic Bitcoin reserve, the executive order that codified this, the Trump administration. For a while, it seemed like, there was endless catalysts, right? There was the strategic Bitcoin reserves, there was the Bitcoin treasury companies, there was MicroStrategy. It does feel like there's some fatigue in the market. So what are you looking at Q1, Q2? Is there something on the table, something that you still think could kind of break and then turn the market positive next year as the calendar turns?
I think all the trends are actually very positive. I mean, there's really no reason for Bitcoin to go down. If we look at other cryptocurrencies or trading tokens, as I prefer to call them, that's certainly not the case. But the biggest catalyst by far is what the Bitcoin strategic reserve in the United States wasn't. Everyone was hoping that Trump would announce we're going to buy. The U.S. government is going to buy BTC. No, nothing of the sort. The U.S. government, as far as I know, has never bought any cryptocurrency, any trading token, any Bitcoin at all. What Trump did say is, okay, let's put all of this stuff together. And it's well known for years that the U.S. Marshals Service has had by far the biggest bag of BTC in the U.S. government. So now it's been consolidated. And I've been surprised that there haven't been more larger countries that have gotten into that game. You have everybody from the, smaller countries from Bhutan, which has been Bitcoin
Pakistan,
mining, it turns
El
out, for
Salvador.
years. What's that?
I said Pakistan, El Salvador. We've seen some movement.
El Salvador has been buying very steadily, despite the fact that the IMF is not really a fan. And there have been a number, there are like a dozen, maybe more smaller countries at this point in time who have jumped onto this bandwagon. Of course, when you see this drop, everybody else is going, told you so, bad idea. But it really is a function of your time horizon. We have not seen a lot of larger governments, whether they be national governments or, provinces, states, or whatever the subdivisions are, buy Bitcoin yet. But I think that is something that remains to happen. And that would be the next 18-month rotation into those sort of entities. They've started, I think the first state that actually bought, there was a little bit of a race. It was Utah and Texas for a while. I think Texas won the race because they actually were the first state government that said we're going to spend state funds to actually buy, as opposed to a consolidation maneuver. I don't know that they have actually bought, but just think about it. If you have all the provinces in Canada and Australia, several states in the United States, governments in Western Europe, I mean, they're facing real deficit problems. Many governments are, but if they start buying slowly, even, and that becomes news, it could have a massive impact on BTC because the available float is really maximized now. More is probably lost than mined in a given year. Nobody knows that statistic, but there's so little left to be mined that, and people lose BTC all the time. I would be astonished if the net active supply is going up. And then you have last year, for instance, where Just Strategy bought more during the year than all the Bitcoin that were mined. So we're in a real, deflationary spiral with BTC, and that's accelerating as you get more whales who just hold, more hodlers, if you will, more losses and fewer mined, and plus bigger actors buying. I mean, my God, that's the textbook definition of a supply shortage, which always leads inevitably to higher prices.
I'm curious, speaking of catalysts, we talked about the Trump administration. Still on the board is market structure, right? And so there's a lot of folks, I think, who want to see this pass. They think it will be broadly embolden sort of the digital asset space. And, we would expect banks to sort of get into the retail game of buying and selling, not just Bitcoin, but other cryptocurrencies as well. Are you bullish on the market structure bill? And how quickly do you think, if it does pass, you'll see the big banks get active in the market? Will that happen next year?
It's two interesting questions. My company, we don't really talk about, we have some yield generation on one side and VC on the other. Our second generation VC fund invested in a company that was just approved by the state of Illinois to buy what I sort of tongue-in-cheek call a pet bank of the Chicago Board of Trade. Chicago Board of Trade is on the second story of a building on Wacker Avenue, which is the unfortunately named Financial Street in Chicago. Chicago Board of CBOT is on the second floor. This company called Burling Bank is on the first floor. This company, Level Field, that we invested in, just got approved by the regulators of the state of Illinois to buy that bank. And as the country's first crypto forward bank. And the Fed today, actually, or tomorrow, is supposed to, they've already said that, if the state says we'll go ahead, so they'll go ahead. And the feds will go ahead and issue approval as well. Unlike Anchorage, which claims to be a bank, and technically they're correct, but they're chartered by the OCC, the Office of Comptroller of the Currency. It's a trust bank, so they can't be covered by FDIC insurance, a bunch of other things. It's not a full service bank. So Burling, after this deal, which with any luck will close this year, worst case it'll close early next year, will already be the first crypto forward bank in the nation. And that is under current laws. You don't need any change to current law in the United States for banks to get more active in the crypto space. The real question is, you have tier one capital in banks. Can you count crypto assets toward tier one capital? The answer is no right now. And so Burling Bank and Levelfield, they aren't doing that. Their application was approved on that basis by the state of Illinois. And you can function quite well today. It's really, it's a question really of an attitude. And if people think, okay, look, we're gonna have crypto, we're gonna lend against crypto, but we're not gonna count crypto on our tier one capital. If you can deal with that sort of thing, then you're fine. You're fine, absolutely not right now. All that being said, there's still ambiguity because let's face it, regulation always trails innovation. And if you had laws written specifically to deal with cryptocurrencies, you wouldn't have the square peg round hole problem you have now, which is, okay, you're going to lend out $150 million, which is what the license that this bank is getting, or the charter says initially. And you're going to have 150 million of BTC on your balance sheet. Zero counts as tier one capital. So it doesn't increase your asset base so you can lend more. Makes absolutely no sense. They can still do it. It's great, but it makes it harder. It makes it incrementally harder. Anything that clarifies the situation in the U.S., even if it's bad news, right? There's a question I like to ask people. Would you rather have, and pardon my French, would you rather have a boss who's an asshole one day and a really great guy the next, but it's random, you don't know which one you're getting in the morning? Or would you rather have a boss that's an asshole all the time and it's predictable and you know what you have to deal with? The door number B, right? The asshole every day is much, much better. Bad regulation in the U.S., clear bad regulation, is better than the complete absence of regulation. And I think we're getting, if you look at the Genius Act and look at a couple other things, what we're getting is relatively clear. It's kind of muddy, but most regulations or laws are at the beginning, and the regulations that implement them are still a little bit vague. But over time, you get the second, third, fourth version, iteration, amendments, and everything else. It gets better. So what we're seeing now is mediocre legislation because it's early and because it's a little bit tighter. It regulates a little bit more than most, crypto fanatics, even if you're not a Bitcoin maxi or something, would like, but it's clarity. Business loves clarity. They're bad rules, okay, but if you're not changing them every day, I can deal with these bad rules. And that's what you're seeing now.
I got to wind back the clock a little bit before we cut this one off. But you were in the Bitcoin market, back in 2013, back in the double digits. It was a small market, maybe hadn't even crossed $1 billion yet. When you're talking to new folks who are coming to the market, how do they must be asking you, they must be saying, how can I benefit from Bitcoin and cryptocurrencies as much as you have? How do you have those conversations, right? How do you tell them that there's still sort of this bright future ahead? And are you able to make a convincing argument?
Strangely enough, in 2013, I actually ran the world's first crypto fund. Bitcoin was the only token. So, and this fund was cleverly called the Bitcoin Fund. And it was kind of like a slow ETF. When people subscribed to the fund, it bought Bitcoin. When people redeemed, it sold Bitcoin. The guys that founded it didn't know much about fund management. I did. And when they asked me to run it, I said, I don't know what this stupid Bitcoin thing is. But since there's no discretionary management involved, sure, I'll manage this thing for you. So yes, I've been looking at BTC for a long time. And now the upside is absolutely massive because BTC is deflationary. This is an asset that people like. People are attracted to. The world has gotten over the fact that, okay, there's nothing backing it per se, partly because there's nothing backing the US dollar per se or euro per se. Like when I first looked at it, I thought fiat was up here and Bitcoin was here. I dug into, what's wrong, what could be wrong with Bitcoin. There was nothing there or nothing so special. So I thought, maybe I'm comparing it to the wrong thing. And as I started digging into the nature of money, I realized, hey, there's no material difference between them. There's a comfort level and historical financial inertia. I'll go back to that. There's a lot of that behind fiat. Otherwise, it wouldn't work. If you would try to introduce dollars in the Roman Empire that were not backed by anything, everyone would go, what the hell are you talking about, right? But it's hard metal represented by coins, then represented by dollars, and or represented by paper money, and then but clearly backed. And the U.S. dollar, which is never by law more than 40% backed anyway, but people didn't know that backed by gold was a thing, and many people still get that confused now. And so you break that on August, or Nixon finished what Roosevelt started, broke it completely on August 1571. And so that evolution was necessary. You couldn't have just skipped a whole bunch of stages and gone to paper money that isn't backed by anything, right? It's accepted because people believe it has value. I mean, from that perspective, money has almost become a religious question, because if we all believe one day it's worthless, hey, it would be worthless. Bitcoin fits very nicely into that, but unlike every other currency, it's deflationary. Logic dictates that the price is going to go up. And if you worry about, hey, what happens if everybody does wake up and suddenly, Bitcoin, they all think Bitcoin isn't worth anything. Look at the example of gold. Gold's $4,000 an ounce. Why does gold cost $4,000 an ounce? If it were only used for its industrial purpose, for its inherent value, it's the best room temperature conductor we know of. It's malleable, soft. It can plate in micromillimeters. It's an incredible metal. Its physical characteristics, and it costs a certain amount to pull it out of the ground. The intrinsic value of gold is $800-900 an ounce. Thinking, what does it take to pull it out of the ground, and what's its value for industrial purposes? Everything else is because gold is pretty. That's it. And so 3/4 of the value of gold is exactly equivalent to BTC. People like it because they like it. It's worth something because people like it. It's a bit of circular logic, which we don't really examine when we look at TradFi because of historical financial inertia. Hey, gold's always been there. It's in human history for 10,000 years. We like it because we like it. And in the meme coin environment, that may be a little bit easier, or meme stock environment, maybe a little bit easier to understand. But you have to believe that the perceived value of crypto, of Bitcoin, will remain. Once you reach that conclusion, it becomes insanely valuable. Because rather than the amount, the new BTC slowing down, the BTC that's in the wild is actually shrinking, because mining does not outpace losses. And people are getting more and more careful. They lose fewer and fewer Bitcoin, but people still lose them. And there's very little being mined now, and each Bitcoin that you mine is obviously worth $80,000, but there aren't many of them left out there. Where can you invest in a commodity that supply and demand is going to drive the price up significantly? Because it's not like lithium, right? Which you've been going crazy because of use in batteries. But if you find a new deposit, boom, it collapses. There are going to be no new deposits of Bitcoin. End of story. That is a really, really strong investment case.
Tim, final question as we wrap it up. If you could go back to yourself in 2013, obviously you were early, you saw the Bitcoin opportunity, you dove in, you went down the rabbit hole. What advice are you giving yourself for all these years?
It's general trading advice I've learned from being wrong a lot. And that is, there are two things people do wrong. One, they get a bunch of money from wherever, and they decide to invest. And whether it's Bitcoin or whether it's crypto or fiat, it doesn't matter. Don't invest because you have a lot of money in your pocket. Take the time to look at the market and find when a good entry point is, both on a macro level and a micro level, whatever you happen to be, whatever you happen to favor. And you're also better off investing in things that you have knowledge of. But the second principle, aside from not investing just because money's burning a hole in your pocket, and there's a reason that aphorism exists, is don't ask yourself binary investment questions. If you own, hey, should I sell? If you don't own, hey, should I buy? The best principle in investing, aside from diversification, is the DCA, dollar cost averaging principle. You don't know if it's the absolute best time to buy or sell. Usually. November 15th, 2022, when everything collapsed, that was like, okay, time to get in. It was
back then you knew.
Yeah. And when COVID, I was the CIO, the chief investment officer of a 9 wannabe 10-digit family office that does no crypto. Had that position for 9 years until last summer. And when there was a COVID drop, we bought futures. We bought stock index futures, made 85% in 3 weeks and then got out. There are times where when there are crises, the time horizon of markets get real short. And if there's a major crisis, the time horizon is really, really short. So instead of playing a 2-year cycle, you're playing a 2-hour cycle or a 2-minute cycle. I mean, the price of oil went negative, for crying out loud. I mean, how much more stupid could you get? But that's because the market loses its rationality in the crisis. So yes, in those circumstances, which happen once a year, once every 2 years, you want to make a quick decision. And if you're experienced in the market, if you've gotten smart over the years and recognize these points, great, you can do that. But if you're not, and the vast majority of people are not, and these things don't happen all that often, edge in and edge out. You won't hit the high, you won't sell at the high, you won't buy at the low, but you'll sell near the high, you'll buy near the low, and don't have buyer's remorse. When you're out, you're out. Did you make money? Wonderful. It was a great trade. If you look at the asset that you sold, or happens to be, and it's still moving up or down, then you take with fresh eyes, you look at it again. Do I want to buy when it's up here, since when I bought down here and I sold up there? Or do I just want to be patient, wait for a next cycle, and I'll look at something else now? Don't be in a hurry, either to invest because you have money or to get in or get out of a position. There is not often, certainly does happen, but it's not often that there's a clear, I got to get out 100%. I got to get in 100%. And too many people trade like that unnecessarily.
Wise words, Tim. Salion, what can you tell us? Where can we find more about how you're investing in the present?
Salion, P-S-A-L-I-O-N. It's ancient Greek for chain. All the real words and good languages, modern languages were taken. As I said, it's got a yield aspect to it. We don't trade anymore because trading is hard, right? You got to be right a lot, and one being badly wrong once will wipe out a lot of being right. So it is a yield liquidity allocation. It just keeps printing money. We've done $13 billion worth of allocations to liquidity pools and never had a non-positive result. We have sort of a curious twist on it, which if anybody wants, I can explain it. The other side is VC. We've had 3 ventures of VC funds, 3 vintages rather of VC funds. The second one's about halfway through. First one's done and dusted. Second one, we're in the management harvest phase. And the third, we're actually launching. We launched about 2 months ago the fundraise for it. It's going very, very well because the success of the other 2 has been documented and was quite good. And those are really the 2 branches that we have. Offices here in San Diego, where I am, in Geneva, and in Singapore. Not all that big, 11 people, so it's not like massive offices every place. But it's a very nice business. We started from scratch about 5 years ago, and we have about $250 million under management now, which isn't bad for 5 years from nothing. And we're really pleased with Salion. If anyone's interested, salion.com, reach out.
All right, Tim, appreciate the time. Of course, we'll be checking the results. Maybe we'll loop back in Q1, Q2, see if we're still in bullish territory. For now, if you're online, go check out Salion, go check out Tim's published work, check out blockworks.co. You can see all the great podcasts being published on the site. For now, this has been Supply Shock, a Blockworks podcast. Thanks for tuning in.